as we get, even further when it comes to the yield curve inversion, recession risks are building. It seems like risks more broadly as we get to this point in the tightening cycle are really elevated. So how are you balancing the way that you invest now?
So our core recession view is still intact, just that the timing of when recession will occur, we have pushed that back by about 2 quarters or so to the first half of 2024. And the key reason for that is really the very resilient economic data that we've seen coming out from the US, particularly in the consumer sector as well as among the labor markets. Because if we look at where we stand today, the manufacturing sector is certainly in a recession, but the consumer sector is still humming along very, very nicely. And I think one of the key drivers for that is really the buildup of excess savings that we have seen during the pandemic that have resulted in the consumers and the labor market being much more resilient than what we were expecting, which is why from our perspective, recession risk has been postponed, but it's still going to occur. And as a result of that, we have actually upgraded our equity to a neutral or rather core holding for the next 12 months.
So to keep calm and carry on, how does that approach, I guess, a little bit more difficult markets at the moment that are still waiting on stimulus like China?
So I think one of our key recommendations to clients is to keep calm and carry on. And that's really, if you think about the actions that we have taken over the last month, we've upgraded equities to a core neutral holding. But on against that backdrop, we have actually balanced that with an overweight to developed market investment grade bond because of our view that the rate hiking cycle by major central banks, but particularly so for the Federal Reserve, is probably towards the tail end. Yes, we have seen from the FOMC minutes last month that the Federal Reserve is still expecting another 2 rate hikes. And the market, however, is pricing just about 1 rate hike from now to the end of the year. But suffice to say, the bulk of the rate hiking cycle is likely behind us, even though we might still get 1 or 2 rate hikes from now till December. So against that backdrop, our view is that developed market investment-grade sovereign bonds as well as investment corporate bonds are actually quite interesting candidates to be looking at for investors to be locking in the yield as central banks take a pause and eventually move to an easing cycle. And when an easing cycle occurs, then what that means is that the cash yield will probably reduce that. So what this means is yields for investment-grade bonds as well as bonds with longer-term maturity is actually looking quite attractive right now in the context of an eventual rate hiking cycle to occur.
So, Audrey, we are, of course, expecting major banks to report earnings next week, and that would start the earnings season in earnest here in the U.S. What are you factoring in terms of the next catalyst in terms of global equities as we head towards the next earnings season?
I think next week's earnings season will be a key validation or rather checkpoint for markets as well as for investors. If we look at how the overall expectations has been stacking up, analysts have been revising down their earnings estimates for Q2. So if you look at the current estimates that they're expecting is about negative 6.8%, which is one of the lowest quarterly year-on-year growth rate since the second quarter of 2020. And given that expectations has already been very much lowered, and yet we still see economic data actually humming along quite nicely. And if you look at the U.S. Economic Surprise Index, for example, they are still firmly in the positive territory. There is some sense that in the event that earnings turn out to be better than the negative 6.8% that's been expected by consensus, then there's probably room for the equity rally that we have been seeing so far to extend and continue. And then if we look at from a short-term positioning perspective as well, no doubt we have seen a pickup in sentiments, but positioning by most investors, if you look at CFTC data, investors are still quite net short, so quite a fair bit of catching up to do as well.